Let's get across the market open now. Zach Riaz joining us from Banyan Tree Investment Management. Zach, welcome back to you. Let's first start with those developments we've seen overnight. Oil prices plunging off the back, of course, of that suspension of hostilities in the Middle East. What are you seeing there? A bit of a mixed session, it has to be said, on Wall Street, with chip stocks under further pressure.
Yeah, good morning, Andrew. Well, I mean, mixed is a very appropriate word, to be honest, because I don't, the yo-yo in obviously the geopolitical environment is just creating this whipsawing, movement in markets. Oil is up one day, oil is down one day. We've got a ceasefire apparently again, and there's a good chance of a deal. That's a direct quote from Donald Trump. But I think the geopolitical events are going to bubble away in the background. I think center stage right now is obviously as you said, the earnings from the hyperscalers, which were faded, and then obviously the upcoming the Fed decision as well, so it rates and what happens with that. Obviously, off the back of oil prices declining, there's been a bit of a reprieve for yields and inflation expectations. But what's very interesting from globally, obviously, is the fade in still pretty strong earnings from the hyperscalers. And at some point, you would think the board members of these hyperscalers will be sitting around and saying, we're seeing our free cash flow profile being absolutely decimated. Maybe it's time to pull back a little bit on that profile, or improve that profile a little bit. And we've seen obviously Meta try to, the renting of GPUs. So that's the kind of landscape we're looking at right now.
Do you think that's likely to transpire, though? I mean, it looks to be a race to who can spend the most at the moment.
Yeah, look, it's very interesting. I think it's a very US-centric mentality. When we've been covering emerging market Chinese stocks and US stocks for 15 plus years now, and the psyche is very different. I think everyone knows this is not rocket science to anyone that's been covering the two different management psyches. In the US, it's spend first, think later. And in China and in Asia, it's really be as measured as you can, which sometimes could be a double-edged sword because you get left behind. So I think at some point you will start to make those decisions at a board level, Andrew, because at the end of the day, the price movement suggests to you that investors are saying, look, I see the demand, I see all this ahead, but at the end of the day, we want to see some returns as well. So the investors have started to speak, and one of the stories of the bulls is basically, well, earnings are still growing, and because of the price movement that you're seeing over the last week, valuation multiples are at very reasonable levels. Yes, that's a bull case, but you can look at it the other way and say investors are saying, I just am not willing to pay multiples as high as yesteryears, and something that maybe people have become accustomed to. So I think the markets are speaking. The boards may have to start speaking to their management teams.
So, Zach, let's focus then locally. Reporting season upon us. What are the expectations there? Perhaps we can break this down sector by sector.
Yeah, look, I think it has to be sector by sector, Andrew, because I think at the headline level, at the ASX 200, 300 level, I think it's going to be a mixed result. Certainly from an asset allocation point of view, we continue to see much better earning opportunities offshore. But bringing that to Australia, I mean, let's just go through some of the key sectors. I mean, energy, I think, is going to be mixed. One day we're on, one day we're off with this Middle East tension. And so oil prices are bouncing around. The reason why we're a bit more mixed with energy equities is because, we think the issue in the Middle East is going to keep bouncing around. But the reason why we're not a lot more positive on it is because at the end of the day, there have been significant earnings revision to the upside in the first half of this year. So the risk really is that earnings have been more than appropriately revised up for these energy stocks. And as we get closer to a deal, there's a chance of downgrade. So that's the reason for us being a bit more mixed on energy markets. But I think there is still a vast difference between physical oil markets and financial oil markets. So within energy, we're a bit more mixed. Consumer discretionary, I think, has seen a lot of revisions recently. So there's a bit of optimism coming back in. But I think on the ground situation, I was looking at the Westpac credit data, credit card debt spend data, still very mixed from our perspective anyway. So I think there's a bit of downside risk in consumer discretionary stocks because of the positive revisions that we've seen. So we would be a little bit cautious there and tread carefully. Healthcare, obviously been a basket case already. Cochlear, CSL have all come down with downgrades already. I know we've seen a really nice bounce back in healthcare stocks from probably oversold levels, but it's more of a reversion to mean rather than a low-hanging fruit, dead cat bounce, whatever you want to call it, versus any sort of fundamental change to earnings. And I would still tread a little bit cautiously into healthcare stocks. And frankly, some of these healthcare stocks are really well owned anyway. Materials is no surprisingly to anybody. It should be there's potential upside risk within materials. I would call out lithium miners. I think we were looking at the lithium prices just yesterday, and I think there is potential. And we've actually been saying this since the start of this year. If there was one area where we thought there was upgrade earning cycles within the materials sector, there was lithium, because lithium prices are obviously bounced back after a couple of years in the doldrums because of that oversupply, and so demand is still looking pretty hot. And now we're potentially up in a earnings upgrade cycle, which is very different to the last couple of years. So watch out for lithium miners and what happens then.
Sorry, Zach, how would you play that? What sort of stocks would you be looking at?
And look, within lithium, we like Pilbara. PLS is probably the way that's our preferred play. And then the more sort of the general space of cleaner energy, critical minerals and whatnot, IGO, and then also Aluka, but along with holding obviously the bigger guys. So that's kind of the lithium space, probably more Pilbara, and then within sort of mid cap, pure play copper is Capstone.
All right, now financials, obviously that other large sector that dominates. How are you looking at the banks at the moment?
Yeah. So this is very important. So a client actually asked us just recently, Andrew, look, what is the impact on moderating mortgage growth on the big banks? Because obviously everything that's happening with auction clearance rates and whatnot. So we ran some numbers. Look, it's not perfect sensitivity analysis because you do keep a lot of key indicators obviously static. But long story short, 100 basis point movement in mortgage growth for these big majors equates to about half a percent to 1%. Obviously, the guys with the biggest mortgage book, like your CBAs and Westpacs, have a much bigger impact. But all else being equal, a very simplistic sensitivity analysis suggests that 100 basis movement in mortgage growth rate within the P&L of these major banks is not catastrophic. It's more than NIM margins, which obviously, if there are issues permeating through mortgage growth because of lack of demand, and then there's more competition, then that's where NIM margins come in. And that's when you start to get 3 to 4 to 5% hit, depending on which way margins are going. So that just gives you a bit of an idea of how this current sort of, lackluster outlook in property market could play out. So we are neutral on the financials because they generally are, really well capitalized. The yield is not all that attractive, but with franking gets you there, especially when you compare it to the ASX 200. So we are neutral on financials, but I think that could be a point of soreness for market returns going forward. One area we do like is industrials and REITs, more so capex, and so SGH is one that we like in the industrial space because of the capital cycle in Australia, particularly around infrastructure, critical infrastructure, critical minerals, and obviously the broader mining. And then within REITs, I've spoken about it before, retail REITs, high quality retail REITs. Just go into any shopping center that's in a densely populated area. Anyone thinks that people are sitting at home and just using online shopping has got rocks in their head. People are out there wanting experience. So the releasing trends of these high quality retail REITs, I think, are going to continue to be positively impacted. So there are a couple of areas that we like.